with me now. Go with me now. I'm gonna take you down. Go with me now. I'm gonna show you how. Go with me now.
All right, welcome to the second half of our financial markets lecture. We're basically going to kind of delve deeper into the loanable funds market and just look at the components of it, stocks, bonds, investment banks, things like that. So anyway, kind of dovetails on what we did last class. Where do you get funding if you want to start a new car company? Okay, you have to find investors. Those investors are saving their money, and then you're borrowing that money. So again, we're demonstrating that savers lend money to companies so they can make investment. All right, and without a functioning loanable funds market, those investments just aren't going to be made. All right, so we are covering financial markets. You're going to learn all of these things. Very exciting. All right, so how do financial markets help the economy? Now here's the thing. We've kind of already demonstrated how they help the economy, but let's make sure we understand that there are these things called intermediaries that help make it possible for savers to loan money to borrowers. Okay, and so we have banks, for example. Banks are important because they bring the savers and the borrowers together. Okay, otherwise, if you wanted to borrow money, you would have to solicit funds from thousands of people that you don't even know, and can you imagine the headache that would cause? So banks are very important. They make the loaning in the economy more efficient. All right. Now there is, if you were to start a business, there are two ways to get finance. There's indirect finance and then there's direct finance. So indirect finance occurs most of the time with what we're talking about with a bank. Okay. Savers deposit funds in a bank, and then investors, when I say investors, I'm talking about people who are purchasing capital to start a business. Okay, they go to the bank and borrow those savers' monies. So it's an indirect way of getting the money from the savers. All right, direct finance is where you would actually borrow money directly from the source. So stocks and bonds are a good example of that. If you were to buy stock in a company, you're actually giving money directly to the company so that they can use it to make investments. Okay, so that's kind of the difference between the two. It's pretty straightforward. Direct means you're getting money directly from somebody, whereas indirect, you're going through a financial intermediary. All right, so here's some examples. We had the hands-free selfie stick. It was our example of a new company. Here are some ways you could get funding. If you borrow money directly, I've screwed that one up. Oh well, if you borrow money from your father-in-law, that would be direct finance because you're getting it directly from the source. All right. What about if you take out a loan from the local bank? Okay. The bank is loaning you not their money, but their depositors' money, so that would be indirect. What about if you sell bonds to people in your econ class? Bonds, we're going to learn today, is a form of a loan. And so in this case, you're directly borrowing money from people, so that would be direct. And what about if you go on Shark Tank and Mark Cuban loans you the money? Well, again, you're getting it directly from the source. Okay? So that's kind of the difference between direct versus indirect finance. All right, so financial tools. Here are the things we're going to discuss today. We're going to talk about bonds, stocks, treasury securities, home mortgages, other private sector securities, like student loans. These are all financial tools that help us to do things in the economy. All right. So let's talk about bonds first. Bonds are used primarily by large established corporations. And the reason is because large established corporations can generally borrow money at a lower interest rate, and so bonds become an attractive option for them. Now, this could be a way we could raise money for our hands-free selfie stick factory, okay, even though our company's not well established. So what is a bond? It is a security, meaning basically it's a loan, okay? The security is issued and sold to the public. So that means the public is buying these things, but the purchase of the bond is a way that the company is borrowing money from those purchasers. Okay, it's a example of direct finance, and the funds generated in this respect are used for investment. Now, what is a bond? It's actually a loan. So it is a formal IOU, meaning I owe you money, and that is a contract that specifies who owes how much and what date is the payment made. Alright, so here's an example of a bond, and this is the information you will find on every bond. Okay, number one, the name of the borrower. So since McDonald's is issuing this bond, they are the one borrowing the money. Okay, it has a repayment date, so this one is due in 1993. Alright, somewhere on there will be a specific date. Let's see, the amount due at repayment. So this is the face value of the bond. So this is what's due at repayment. This is not how much the bond cost. Okay, the bond is going to cost whatever it costs based on the interest rate being charged, and so that could vary. All we know for sure though is that at the date of repayment the bond is worth $1,000. Okay, so why would somebody buy a bond? Well, it's a form of saving money, and as a bond buyer you would want to achieve the highest possible interest rate. Okay, and they generally will pay a lot more than a savings account, so that's one reason people would buy bonds. Okay, sellers, this is a way to borrow money. Okay, instead of borrowing from a bank, they're borrowing directly from the public. Usually they could get a lower interest rate on their bond than they could on a direct loan. Alright, so the idea here is that a bond buyer wants to pay a really low price for the bond, whereas the bond seller wants to sell it at a very high price, and those prices are going to determine the interest rate. We're going to see how that works in a sec. Alright, so back to our hands-free selfie stick company. Here is how the interest rate and the price of a bond is determined. Okay, the interest rate is found by taking the face value of the bond, subtracting the price of the bond, okay, then dividing by the price of the bond, and then multiplying by 100. So for example, if Amy buys a $1,000 bond for $800, the face value is $1,000. The price at inception is $800. If we divide that by $800 and then multiply by 100, that's going to be 2 over 8, 1 over 4 times 100 is 25%. Okay, so that's how we would calculate the interest rate. We just take the price at inception, subtract it from the face value, divide by the price at inception, multiply by 100, you get your interest rate. So let's do a little practice. Y'all go ahead and work on that, and I'll come back. Alright, here we go. So if the price, if the par value of the bond is 1,000, that's the face value. Okay, you take your 1,000 and then you subtract the price of the bond, $975, and then divide by $975 and then multiply that whole thing by 100. What do you get? Well, I've got to use my calculator. So I'm going to take the difference between those two prices, which is $25, divide by the price at inception, which was $975, times 100. I'm going to get 2.56%. That would be the interest rate on this bond. Okay. Now, what if we have the interest rate and we have the face value? How do we calculate the price of the bond? Well, we just rearrange our formula, and so we get the price at inception, which is what we're trying to calculate. I'll call it X for now. And then we take the face value, which was 1,000, and then we're going to divide by 1 plus the interest rate divided by 100. Now that's confusing speak for basically taking the 10%, dividing by 100, which gives you 0.10. So it's 1,000 divided by 1 plus 0.10. Alright, and what do we get when we do that? 1,000 divided by 1.1 is 909.09. That would be the price of the bond at inception if the interest rate were 10%. So really what we're discovering here is that the price of the bond determines the interest rate, or conversely, the interest rate will determine the price of the bond. Okay, the point is that the higher the price of the bond, the lower the interest rate. And the higher the price of the bond, or I'm sorry, the lower the price of the bond, the higher the interest rate. So here we have several more examples we can do, and I want y'all to go ahead and do it, and we'll go over them later. But basically you're finding X in this table. So either you're given the dollar price or you're given the interest rate. You need to figure out the other. All right. So we can cover that another day. Now let's talk about default risk. So there's basically two things that can happen with a bond. Either on maturity it's paid back, or it's not paid back. If it's not paid back, that situation's called default. And default just means that the borrower is not going to pay you back as the person who purchased the bond. That does happen on occasion, and that's called default risk. Now I'll give you an example. If we actually did open the hands-free selfie stick company, I have a feeling that company would go out of business, and it's very likely that it would default on its bonds. Okay? If there's a high risk of default, that means that the interest rate on the bond is going to be much higher. Okay? So the interest rate is determined by the price of the bond, but the price of the bond is determined by the default risk. So the higher the default risk, the higher the interest rate. All right. So here's an example. In Greece, they had a situation a couple years back where they were at great risk of defaulting on their loans. All right. As a result, you can see their interest rates paid on their bonds went from 1.78% all the way up to 177%. And the reason it went up so high was because there was a great risk of default. So to convince people to loan them money, they had to pay a much higher interest rate. So that's why default risk is so important. Now, there are bond ratings that help people determine what the risk is. Okay, it's kind of like a credit report for companies. So the lower the rating, the higher the risk, and the higher the risk, the higher the interest rate. And so that's basically how everything works. All right. Generally speaking, very long-standing, profitable, successful companies and institutions have very high credit ratings or bond ratings. Companies that may be in trouble, don't have a good track record, or for whatever reason are risky, are going to have the lower credit ratings. All right. The USA has a pretty high credit rating, AA+. Alright, so why do prices fall when bonds are downgraded? So here's basically what happens. So the interest rate on a bond is going to go higher when the default risk goes up. The reason that happens is because the demand for the bond drops when the risk is higher. And when the demand drops, the price goes down. And we remember that bond prices and interest rates are inversely related. So when the price of the bond goes down, the interest rate by default has to go higher. And that's why higher interest rates exist when you have higher credit risk. Alright, so bonds go up, interest rates go down, and vice versa. When bond prices go down, interest rates go up. So let's talk about stocks. Alright, stocks are a little bit different. They're very similar, but they're also different. Stocks are also a way to raise money. That's one way that they're similar to bonds, but the reason they're different is because bonds represent debt, whereas stocks represent ownership. So if you issue bonds to raise money for your company, you don't share ownership of your company, but you do take on a liability. All right. Stocks, however, you don't take on any liability, but now you have to share ownership with your company. Okay. Both of these methods are used to raise money. That's the only difference. One represents debt, one represents ownership. All right. Let's talk about secondary markets. Secondary markets are places where bonds and stocks can be sold after the original purchaser buys them. And really, this is most stocks and bonds are actually sold in secondary markets. So these are things like the New York Stock Exchange, the NASDAQ, Chicago Board of Trade, all of these places where people buy and sell bonds and stocks. All right. One of the things that's interesting is that secondary markets actually help stocks and bonds retain their value. And the reason they do is because it offers up more buyers. And whenever there's more buyers, there's greater demand, and so demand goes higher through the existence of secondary markets. All right. So let's demonstrate what we mean by that. So this is the supply and demand of a security when there is no secondary market. Okay. There's just not that many buyers out there, so the demand is where it is. There's the price. However, when there is a secondary market, that exposes the stock to more buyers, therefore the demand is higher. And when the demand is higher, the price is higher. And so that's what helps stocks maintain their value. If you couldn't resell them, then there would not be any value in holding them. So just make sure you understand why secondary markets make securities more valuable. All right, 2 special debt instruments. We're going to talk about Treasury securities, and then we're going to talk about mortgage-backed securities. So Treasury securities are actually going to play an important role in the coming months in our class because they become very important in instituting monetary policy. So Treasury securities are just bonds that are issued by the federal government. Okay, so it's a way that the federal government raises money to spend. As you know, we do have a debt of approximately $20 trillion. And so that $20 trillion is really just all of these bonds added together, through all the people that we owe. So that's what a bond is, or a treasury bond, treasury security. Speaking of all of that, this is from 2011, so it's a little bit dated, but this is who owned a lot of our debt. Okay, so back in 2011 we only owed about $10 trillion. Now we owe $20 trillion. But back then quite a substantial part was owned by foreign entities. Okay, today the foreign entities don't actually own quite as much as a percentage, but there are still some major foreign holders of U.S. Treasuries. Okay, instead of China being number 1, now it's Japan. But it's still a lot. Okay, we still owe them collectively over $2 trillion, so over 10% of our debt. Now let's talk about the home mortgage loan. The home mortgage loan allows banks to make loans to individuals. And the reason this is important is because if you were to just loan $250,000 to an individual, that could be a pretty risky loan because it's one individual. You have to count on them always making the payments, and that could be, you never know what could happen. They could get sick, they could lose their job. It could be very risky. And so there's actually a special way that mortgage companies finance these things, and it's through what's called a mortgage-backed security. Okay, so we're going to look at that. So securitization is just a way to combine a whole bunch of loans into one. And if you think about it, it kind of makes sense, because if you look at these two guys, would anybody feel comfortable loaning them money for a house? I mean, they're probably going to lose the money, they're going to burn down the house, you never know. Okay, so they would be very risky to loan to individually. But we're going to see that securitization is a way that diversifies the risk. It lowers the interest rate so that people can afford to borrow money for houses. And that's a huge part of our economy. Okay, so we're going to look at how this works. By the way, student loans are done in a very similar way. So when you look at this, I want you to realize that college would not be affordable for most people if this method of securitization didn't exist. So this is what we're talking about. Okay, Lloyd borrows $200,000 for a house. So does Harry. So does somebody named Sam. So do I, and some other people. So that's a total of $1 million. All right. So the $1 million, if one bank loaned all of us $1 million, there is a strong likelihood that one or two of us might not pay the loan back. And so that would be a very risky proposition. That's basically a 20% chance that they're not getting their money back. All right. So instead, what they end up doing is this. They cut that $1 million worth of loans into hundreds and even thousands of pieces. Okay. And then they take those hundreds and thousands of pieces and cut them into even more. So basically, you can buy, as an investor, a financial investor, you can buy a portion of my mortgage, maybe $100 worth. And that way it spreads the risk out so that if I don't pay my mortgage, you individually only lose $100. And you might have pieces of thousands of other mortgages. So the risk is spread among millions of people, and that is what allows the interest rate to be low so that people can actually afford to buy a house. In fact, I would challenge you, look up a mortgage calculator and see what the payment on a $250,000 house would be at, say, 10%. That's probably the interest rate that would exist if this type of security didn't exist. Then look at what it would be at 5% interest, and you'll be amazed at the difference, and you'll see that this really does make housing more affordable for people. Anyway, let's summarize. We learned that indirect finance is when savers and lenders utilize banks and other intermediaries as a marketplace for loans. Direct finance, on the other hand, is where borrowers directly get money from the savers, who are the lenders. Okay, we learned about bonds, we learned about stocks. Okay, make sure we know the difference between the two. And then we addressed the U.S. Treasury security and the mortgage-backed security. And those are ways to finance debts. Anyway, I hope you all enjoyed that, and we will talk more about this later.
Walk away.